Most people who are now inside Making Tax Digital think the risk is missing a quarterly deadline. It is not. Or rather, it is not only that. There is a second penalty sitting inside the Making Tax Digital rulebook that almost nobody is talking about. It does not care whether you submitted on time. It does not care whether you paid every penny owed. Failure to maintain digital records or a break in digital links within your accounting software can trigger a penalty of up to £3,000 per quarterly period. Per quarter, not per year, per quarter. 4 quarters in a year. Do the arithmetic. My name is Frank. Welcome back to HMRC Update. Today, I want to explain the digital record rules that came into force on the 6th of April 2026, specifically the hidden penalty structure underneath them, the copy-paste trap that is putting thousands of taxpayers at risk right now without them realizing it, and the exact steps that bring your record keeping into compliance before HMRC's checking systems identify the gap. If you are not subscribed to HMRC Update, please do that now and hit the bell. Making Tax Digital goes significantly further than most people in scope have been told. Subscribe. Let us get into it. From the 6th of April 2026, Making Tax Digital for income tax is mandatory for self-employed individuals and landlords with qualifying gross income above £50,000. The threshold drops to £30,000 from April 2027 and to £20,000 from April 2028. Over 2 million sole traders and landlords are being pulled into Making Tax Digital for income tax. Most are focused on the software, the quarterly updates, and the deadlines. Far fewer are focused on what actually happens when they miss one, or when their record keeping does not meet the rules, even when the deadlines are hit. Let me explain the 2 separate penalty systems running simultaneously, because understanding both is what protects you. Making Tax Digital penalties are a points-based system to encourage compliance.
MTD rules, mostly relating to late submissions or inaccurate record keeping. For each quarterly update you miss, you receive a penalty point. At 4 points, a £200 fine is triggered, plus another £200 for each missed submission deadline after that. That is the visible system, the one that software companies explain and accountants brief clients on. Miss 4 quarterly updates, receive a £200 fine. Each subsequent miss adds another £200. Points stay on your record for 2 years before expiring, but only if you submit everything on time during that period. No Making Tax Digital for income tax penalties will be issued for late submissions of quarterly updates in the 2026 to 2027 tax year. This grace period helps people get to grips with MTD without fear of immediate consequences. That grace period is real. HMRC confirmed it. No penalty points for late quarterly updates this year. But here is what the grace period does not cover. HMRC can impose a penalty of up to £3,000 per quarterly period if records are not maintained using HMRC-recognized MTD for income tax-compatible software. That penalty is separate from the point system. It applies to how you keep your records, not when you file them, and it is not subject to the same grace period as missed quarterly submissions. HMRC can charge a penalty of up to £3,000 for inadequate records. This is separate from the points-based penalties for late quarterly submissions. Record-keeping penalties typically arise during HMRC inquiries. The distinction matters enormously. You can file every quarterly update on time, hit every deadline perfectly, and still face a £3,000 penalty per quarter if the underlying records were not maintained in a compliant way. The filing penalty system and the record-keeping penalty system are independent of each other. Grace period on one does not mean grace period on the other. Drop a comment below if you are inside Making Tax Digital and had no idea there was a separate record-keeping
penalty that the quarterly filing grace period does not cover. Back to what that record-keeping requirement actually means in practice. From April 2026, Making Tax Digital adds a new layer. The transaction record itself, date, amount, category, must be kept digitally. Paper records alone are no longer sufficient for those mandated into MTD. That much most people in scope understand. The part they do not understand is the digital link requirement, and this is where the trap is. If you use multiple systems, data must flow between them via digital links, such as APIs or secure file imports. Copying and pasting or retyping figures is not compliant. A digital link means that data moves from one system to another without a human manually re-entering it at any point in the chain. The moment you copy a figure from one program and type it into another, even if both programs are HMRC approved, you have broken the digital link. That break is a record-keeping failure, and a record-keeping failure is what triggers the up to £3,000 penalty. Here is where this gets concrete for people using spreadsheets, which is a very large number of self-employed people and landlords. You cannot submit MTD updates through the standard HMRC online portal. You need software that connects to HMRC systems through an API. If you already keep records in Excel or Google Sheets, you do not have to abandon them. bridging software reads figures directly from your spreadsheet and submits them to HMRC via API, keeping the digital link intact, as long as you do not manually retype anything along the way. That is the solution. Bridging software sits between your spreadsheet and HMRC systems, reads the figures directly, and submits via API without any manual reentry. The digital link remains unbroken because no human typed the numbers between source and submission, but the bridging software must be in place. If you are currently keeping your records in Excel and then typing the totals
into accounting software before submitting, that process breaks the digital link at the typing stage. The submission goes through, the deadline is met, but the record keeping is non-compliant, and the £3,000 exposure exists. Not keeping digital records. If you do not keep your business records digitally, HMRC can charge you between £5 and £15 for every day you do not comply. Not using digital links. If you manually transfer data instead of using digital links, this is also penalizable. The daily charge for non-digital records sits below the headline £3,000 figure, but accumulates continuously for as long as the records remain non-compliant. And combined with the per-quarter maximum penalty and the points-based filing system, the total worst-case exposure for a single year of non-compliance across all three penalty categories is significantly larger than any individual figure suggests. Now here is what compliant digital record-keeping actually requires. Not theoretically, but practically. MTD does not require you to scan receipts, photograph invoices, or store digital images of paper documents. Your obligations relate to the transaction data, not the source documents. If you buy business supplies and pay by card, the bank transaction appearing in your software feed satisfies the digital record requirement once it is categorized correctly. You do not need to attach a digital copy of the receipt inside the software. You do need to keep the physical receipt, because HMRC can ask for evidence of a claimed expense during a compliance check, but that is a separate obligation from the digital record requirement. The minimum digital record for each transaction under Making Tax Digital is the date, the amount, and the category, income, or the type of expense. Those three data points must exist in your compatible software. They must have arrived there digitally, not through manual typing from a paper record. And the software must be on HMRC's approved list, connecting to their systems via API for quarterly submissions. So here is the complete action list, in order of priority. Confirm whether you are in scope. Gross income above £50,000 from self-employment and property combined in 2024 to 2025 means Making Tax Digital applies from April 2026. Approaching £30,000 means April 2027. Approaching £20,000 means April 2028. Check at gov.uk. Confirm your software is on HMRC's approved list. The approved list is at gov.uk. If your software is not on it, it cannot submit to HMRC's API, regardless of how well it generates the figures. Switch to approved software before your next quarterly deadline. If you use spreadsheets, confirm bridging software is in place between your spreadsheet and HMRC. The bridging software must read directly from the spreadsheet without manual re-entry of any figure. QuickBooks, Xero, FreeAgent, and several others handle this natively. If you prefer to keep your spreadsheet, specific bridging tools connect it to HMRC's API without changing your records. Audit your current record transfer process for any manual re-entry. If figures pass through human hands at any point between their source and their submission to HMRC, that is a digital link break. Identify where it happens and replace it with a digital transfer, a bank feed, an API connection, or bridging software. Know your remaining quarterly deadlines for 2026 to 2027. The quarterly update for the period 6 October 2026 to 5 January 2027 is due by 7 February 2027. The quarterly update for the period 6 January 2027 to 5 April 2027 is due by 7 May 2027. Set reminders now. The grace period on points this year does not make the deadlines optional. It makes the filing penalties deferred. The record-keeping penalty is not deferred. And keep your digital records and the underlying paperwork behind them for at least 5 years after the 31 January deadline for the relevant tax year. HMRC can open compliance checks going back multiple years, and inadequate records discovered during an inquiry trigger the penalty structure independently of whether your quarterly submissions were filed on time. The grace period for 2026 to 2027 is genuine and useful, but it is narrower than most people believe. It covers late quarterly submission points. It does not cover the £3,000 record-keeping penalty. It does not cover the final declaration deadline of 31 January 2028, and it does not extend to the next cohort joining in April 2027. They enter the full penalty regime from day one. Share this with a self-employed person or landlord who is using Making Tax Digital but has not reviewed their record-keeping process. The £3,000 penalty is the one nobody warned them about. Subscribe to HMRC Update if you are not already here. I will see you in the next one.